2 weeks ago, while most investors were panicking and selling everything they owned, one man did the opposite. Robert Kiyosaki, the author of Rich Dad, Poor Dad, the best-selling financial book in human history, took millions of dollars in cash and went on a buying spree. Oil wells, gold, silver, Bitcoin. He did not wait for the market to recover. He did not wait for the Iran war to end. He did not wait for certainty. He bought. And in this video, I am going to show you exactly what he bought, exactly why he bought it, and exactly what that tells us about where gold, silver, and the broader market are going next. Because the investors who understand what Kiyosaki is doing right now and why will look back at late March 2026 as one of the most important financial moments of their lives. Let me start with exactly where we are today, because the context matters enormously. It is March 31st, 2026, 5 weeks since the United States and Israel launched Operation Epic Fury against Iran on February 28th. Here is what that 5 weeks has done to global markets. The S&P 500 is down 7.4% from its January all-time high. 5 consecutive weeks of losses. The Dow Jones lost nearly 800 points last Friday alone, closing at 45,166. The Nasdaq has fallen 2.15% in a single session. Oil, Brent crude is trading at $114 per barrel. The Strait of Hormuz, the narrow waterway through which 1/5 of the world's oil and gas supplies flow, remains under Iranian control. 2,500 U.S. Marines have arrived in the Middle East. Thousands more are on the way. Now here is the part that surprises most people. Gold is down. Silver is down. The so-called safe havens are selling off alongside everything else. Gold has dropped 21% from its January high. Silver is down more than 40%. Consumer sentiment has collapsed to 53.3, its lowest level in years. Inflation expectations have risen to 3.8%. This is what financial analysts are calling the everything crash. Safe havens, growth stocks, consumer stocks, all falling together. And most investors are doing one of two things: panicking and selling, or freezing and doing nothing. Robert Kiyosaki is doing neither, and that tells us something very important. On March 15, 2026, Kiyosaki posted something that stopped the financial world cold. He wrote, "Crash accelerates. Private credit funds are panicked as investors withdraw their money. Major big-name banks and brand-name financial institutions are in trouble. Jim Rickards formally declares the U.S. in a new depression." Most people read that and panicked. Kiyosaki's next sentence told a completely different story. He wrote, "Last week I took millions in cash and purchased more oil wells, more gold, silver, and Bitcoin." Let that sink in. While the market was crashing, while gold was falling, while consumer sentiment was collapsing, Robert Kiyosaki spent millions of dollars buying more of the exact assets that were going down. Why would a man with 50 years of investing experience do that? Because he understands something that most retail investors have never been taught. The price of an asset going down does not mean the value of that asset has changed. It means the market's short-term sentiment has changed. And sentiment, unlike value, always reverts. Kiyosaki has been buying gold since 1971. He owns gold mines. He owns silver mines. He owns oil wells in Texas. This is not a man making predictions from a studio. This is a man who has his entire net worth positioned in real assets, and who just doubled down at the moment of maximum fear. The question is, what does he know that you don't? Here is the mechanism that almost nobody in mainstream financial media is explaining clearly. Gold is falling during a war. That seems counterintuitive. Gold is supposed to be the ultimate safe haven. War should push gold higher. So why is gold down 21%? The answer is forced liquidation. When oil surges to $114 a barrel, inflation expectations spike. When inflation expectations spike, the Federal Reserve is expected to keep interest rates high or even raise them. When rates stay high, bonds become more attractive. And when bonds become more attractive, institutional investors, hedge funds, pension funds, central banks sell their gold positions to buy bonds. This selling has nothing to do with gold's long-term value. It is mechanical, it is algorithmic, it is temporary. Here's the proof. Even as oil topped $112, bond yields started falling, not rising, falling. Wall Street has begun pricing in a recession because oil at $114 is so damaging to the global economy that the recession risk it creates eventually outweighs the inflation risk. And when recession risk dominates, the Federal Reserve pivots from raising rates to cutting rates. And when the Fed cuts rates, gold, silver, and beaten-down assets experience the sharpest recoveries. Kiyosaki has seen this cycle play out multiple times. In 1979, in 2001, in 2008. Every time, the investors who bought during the fear, before the pivot, made the generational returns. The gold that is down 21% today is the same gold that will benefit most when the pivot arrives. The silver that is down 40% is the same silver that was up 150% year on year just weeks ago. Now let's talk about the prediction that has the entire financial world divided. On March 16, 2026, just 2 weeks ago, Kiyosaki posted what may be the boldest financial prediction of his career. He wrote, "The biggest bubble bust is coming. I do not know what pin will pop it, but it's not if, it's when. When the bubbles go bust, I predict gold will hit $35,000 an ounce, 1 year after the gold bubble goes pop." He added price targets for silver at $200, Bitcoin at $750,000, Ethereum at $95,000. Wall Street disagrees. Goldman Sachs has gold at $6,000 for year-end. J.P. Morgan says $6,300. UBS and Citigroup are in the same range. So who is right? Here's the honest answer. Nobody knows exactly when or how high, but here is what we do know. Kiyosaki was right that gold would go from $2,000 to $3,700. People laughed at him. It happened. He was right that silver would hit $70, then $80, then $100. People called him crazy. It happened. He predicted the 2008 financial crisis in his 2002 book, 6 years early. His record is not perfect on timing, but his direction has been consistently right. And right now, the direction he is pointing toward gold, silver, and hard assets is supported by data that even Wall Street cannot ignore. The U.S. national debt has crossed $39 trillion. It is growing every day. Since 1971, when Nixon removed the dollar from the gold standard, the dollar has lost over 98% of its purchasing power. Central banks worldwide, China, Russia, India, Poland, Turkey, are buying gold at record levels. Not because they read Kiyosaki, because they understand what fiat currency debasement does to national balance sheets over decades. Now let me make the case for silver specifically, because Kiyosaki has been more aggressive about silver than almost any other asset, and the reason is one that most people have never considered. Silver is not just money, silver is industrial, and war destroys it permanently. Kiyosaki referenced President Eisenhower's farewell address, the famous warning about the military-industrial complex, and he connected it to something very specific. Modern rockets contain between a ½ pound and 4 pounds of silver each. Every time a rocket detonates, that silver is gone, destroyed. It cannot be recovered. It cannot be recycled. It vanishes. As the U.S.-Israel-Iran conflict continues, as missiles are fired and weapons are deployed, silver is being consumed and destroyed at a rate that the market has not yet fully priced. Kiyosaki wrote, "Silver stackers get richer as people on both sides pay the price." He's not celebrating war, he's describing a mechanism. The people who supply war profit, the people who fight it don't, and the investors who hold the raw materials that war consumes benefit. Silver has already surged more than 150% year on year, from $32 per ounce in early 2025 to above $80 in early 2026. It hit a record $116 in January before the war-driven sell-off brought it back to around $70. Kiyosaki's target is $200. That's still a 180% gain from today's price. Even at half that target, $140, that's a 100% return from current levels. The structural argument is real. Industrial demand for silver is growing in electric vehicles, solar panels, smartphones, and now in military hardware. New silver mines are not being built fast enough to keep up. Supply is genuinely constrained. Demand is structurally rising. War is simply accelerating a trend that was already in motion. Here is the uncomfortable question that every investor needs to answer for themselves. On one side, you have Goldman Sachs, JP Morgan, UBS, Citigroup, thousands of analysts, billions in research budgets. Gold target, $6,000. On the other side, you have one man who owns gold mines, silver mines, and oil wells, who has been buying gold since it was $300 an ounce, who just spent millions buying more during the worst crash in years. Gold target, $35,000. Who do you trust? Here is the context the banks would prefer you forget. Goldman Sachs did not predict the 2008 crash. JP Morgan did not predict the 2008 crash. The very institutions telling you gold goes to $6,000 are the same institutions that told clients their mortgage-backed securities were safe in 2007. Kiyosaki told people to prepare for a crash in 2002, 6 years before it happened. The people who listened and bought gold at $300 are sitting on assets worth $4,400 today, a 1,366% return. I am not telling you Kiyosaki is right and the banks are wrong. I am telling you to look at both sides of the argument with equal skepticism and to understand that the banks have structural incentives to keep you in the financial system, in stocks, in bonds, in the products they sell. Kiyosaki's incentive is to sell books and courses. Neither side is perfectly objective. What matters is the underlying data, and the underlying data, $39 trillion in U.S. debt, record central bank gold buying, constrained silver supply, a war that is destroying silver, supports the direction Kiyosaki is pointing. So what is the actual playbook for the next 30 to 90 days? 3 rules that separate the investors who make money in crisis periods from the ones who don't. Rule 1. Do not buy what has already spiked. Oil stocks spiked on February 28th. Defense stocks spiked on March 1st. The investors who made those returns are already sitting on profits. Buying Exxon Martin or Lockheed Martin today means arriving after the crowd, which is where losses originate. Rule 2. Focus on what has been sold indiscriminately. Gold down 21%, silver down 40%. These assets were not sold because their fundamentals changed. They were sold because of mechanical forced liquidation during a sentiment collapse. When the sentiment reverses, and it always does, the most oversold assets experience the sharpest recoveries. Rule 3. Do not use leverage. Goldman Sachs says there is potential for another 5 to 7% downside if the Strait of Hormuz remains closed. If you are leveraged and that happens, you will be forced to sell at the worst possible moment. The investors who profit in crisis periods are the ones who can hold through continued volatility. Remove leverage first, then position, then wait. Kiyosaki's summary is simpler. He said, real gold, real silver, oil, food, Bitcoin. These are the safest investments for 2026. If something can be printed, it is fake. Let me close with the big picture. Every major financial crisis of the last 50 years has created generational wealth for the investors who understood the mechanism rather than reacted to the headline. 1973 oil shock, gold rose 2,300% over the subsequent decade. 2001, a decade-long gold bull market from $250 an ounce. 2008, investors who bought quality assets at the bottom made 300 to 500% over the following decade. The U.S.-Iran war of 2026 is the most significant energy disruption since 1973. The Strait of Hormuz will reopen through military action, diplomacy, or economic pressure. Oil will fall from $115. The Federal Reserve will cut rates because $39 trillion in debt at 4.4% interest makes it mathematically unavoidable. When that pivot comes, the policy panic that Bank of America described to its wealthiest clients, the move will be fast, it will be large, and it will reward the investors who positioned before it arrived, not after. Kiyosaki is already positioned. He told you what he bought. The question is whether you will understand why before the confirmation arrives. Because the confirmation always comes after the move, not before. Drop in the comments, do you think gold hits $35,000, or is Kiyosaki wrong this time? If this video gave you a framework for thinking about your money differently, subscribe, because every week we break down what the banks tell their wealthiest clients and share it with you.